Imagine pausing the global map on a single number, $37 trillion. That is roughly the size of the US national debt when people started openly calling it a ticking time bomb rather than just a dry budget statistic. The figure is so large that it stops feeling real, yet it quietly shapes interest rates, social programs, the strength of the dollar, even the stability of other countries that hold American bonds in their reserves. To talk about how the US could try to wipe out such a number using cryptocurrency and gold, it is important to understand that wipe out here does not mean paying every dollar back, like a household slowly clearing a credit card. It means something more subtle, changing the rules of the game so that, over time, the real burden of the debt shrinks, some of its cost is transferred to others, and part of it is absorbed by the value of assets the state controls, all without announcing a default or causing panic. To see how this works, imagine the US as a gigantic balance sheet. On the liability side are treasuries and other obligations, ultimately adding up to those $37+ trillion. On the asset side is not only the physical infrastructure and tax base of the country, but also more specific financial holdings, the world's largest official hoard of gold, an increasingly strategic interest in digital assets like Bitcoin, and above all, the unique privilege of issuing the primary global reserve currency. Each of these pieces can be adjusted and recombined to quietly work down the debt in real terms. Start with gold because it is the most concrete. The United States holds roughly 8,133 tons of gold in official reserves concentrated in places like Fort Knox and the vaults of the New York Federal Reserve. That number has barely changed in decades, which is one reason people sometimes forget it exists, beyond conspiracy theories, and old photos of gold bars stacked behind fences. On the government's own books, this gold is valued at an official price of about $42 per ounce, a relic from the early 1970s when the dollar was finally cut loose from the last remnants of the gold standard. At that accounting price, the whole hoard is only worth around $11 billion, which is almost comic next to a debt measured in tens of trillions. In reality, of course, the market price of gold is far higher. At modern prices, that same reserve pile is worth on the order of $700 to $900 billion. That is not enough to eliminate $37 trillion, but it is a serious asset, especially when compared with other countries that have been very actively adding to their bullion while the US has simply sat on its existing mountain. The US strategy for years has been not to trade that gold aggressively, but to hold it as a kind of deep collateral, a backstop under the entire monetary system. This creates an interesting possibility. Without selling a single bar, the government could decide at some point to bring its official gold valuation closer to market reality. Doing so would not magically put cash in the Treasury's pocket, but it would dramatically enlarge the asset side of the federal balance sheet on paper. Net debt, which is debt minus financial assets, would fall overnight. Investors, rating agencies, and foreign central banks would suddenly see a United States that is less nakedly leveraged and more obviously backed by hard assets. Such a revaluation could be done quietly and framed as a technical accounting reform, but its psychological impact on perceptions of solvency could be large, especially in a world where other countries are hoarding gold precisely because they fear long-term currency debasement. That is one way gold becomes part of the story, not as a literal payment instrument hauling bars onto ships, but as a tool for strengthening trust and supporting cheaper borrowing, which makes managing $37 trillion less dangerous. Gold also matters as a signal in a multipolar world. When countries like China, Russia, and Turkey buy significant amounts of gold, they are not just diversifying their reserves. They are implicitly saying that they expect the next decades to be more unstable, with sanctions, currency wars, and maybe a partial retreat from the dollar. The US, in contrast, already owns so much gold that it does not need to demonstrate anything by buying more. Its challenge is to ensure that even if the global system shifts a little more toward tangible collateral, the US remains the anchor. If, in some future crisis of confidence, gold prices spike and trust in fiat currencies wobbles, Washington can lean on the fact that its vaults are full, its gold could be revalued, and if necessary, gold-linked instruments could be issued to reassure markets. For example, the Treasury or the Federal Reserve could create bonds whose principal or interest payments are indexed to the gold price. Investors worried about inflation or dollar debasement would happily buy such securities. The government would be locking in a higher cost if gold soared, but in exchange it would secure funding in turbulent times and might be able to refinance older, more burdensome debt at better terms. Now bring cryptocurrency into the picture. At first glance, it seems like the opposite of gold. Intangible rather than physical, rooted in code rather than geology, volatile rather than historically stable. Yet Bitcoin in particular has developed a reputation as digital gold because of its capped supply and the way it attracts investors when trust in traditional systems wavers. For many years, crypto was treated by governments as either a nuisance or a niche, but as its market capitalization grew into the hundreds of billions and then trillions during bull cycles, it became obvious that digital assets were becoming an alternative savings vehicle and, in some countries, a parallel financial system outside the direct reach of Western central banks. For a state like the US, that is both a threat and an opportunity. The threat is that if too much economic activity, savings, and cross-border payments move into a space that the US cannot see or control, then sanctions become weaker, financial instability risks grow, and demand for dollar assets could erode at the margin. The opportunity is that, because digital assets are global and scarce, they can be treated as another layer of reserves or investment, much as some sovereign wealth funds treat tech stocks or real estate. When US officials talk about a strategic Bitcoin reserve, they are tapping into this idea. Use periods of crypto market weakness to accumulate an asset that could appreciate over the long run. Consider the basic math. The government can borrow in its own currency at interest rates that, even when high in historical terms, remain relatively modest compared with the multi-year gains seen in some past crypto cycles. If a small portion of borrowing is effectively transformed into a long-term position in a scarce digital asset, the state is acting like a highly patient, extremely well-capitalized investor. If that asset appreciates faster than the interest on the borrowing, the difference becomes a form of profit that, at scale, can offset part of the debt burden. Of course, this is risky. Bitcoin's price can fall brutally, and no responsible government will bet its core fiscal stability on a speculative asset. But a limited strategic position, especially one integrated with regulatory power and custody infrastructure, can be rational. It is similar to how some central banks hold slices of foreign equities or high-yield assets alongside conservative bonds, looking for extra return without endangering the whole system. Beyond holding crypto directly, the US influences how dollar-linked crypto circulates in the world. That is where stablecoins and the debate over a digital dollar come in. Unlike China, which pushes a centrally issued digital yuan that it directly controls, American policymakers have so far resisted a retail central bank digital currency for the general public. Instead, they have allowed a flourishing private ecosystem of dollar-backed tokens, stablecoins issued by companies and banks that promise each token is backed by safe assets like short-term treasuries and cash. When someone in Latin America or Africa or Southeast Asia buys a dollar stablecoin to protect their savings from local inflation, the issuer typically takes their money and buys US government debt or deposits it in dollar-denominated accounts. In this way, demand for a convenient digital dollar expression becomes demand for US debt. The more global commerce, savings, and even speculations settle in dollar-based tokens, the more people around the world are effectively lending to Washington, often without thinking of it as funding the US deficit. This extension of dollar dominance into the realm of blockchains acts as a quiet amplifier of the old mechanism where foreign central banks and investors buy treasuries. Now, crypto funds, decentralized finance protocols, and ordinary users all over the world, by holding stablecoins, indirectly hold the debt that backs them. The US, by supporting clear rules and relatively friendly treatment for well-regulated stablecoin issuers, is encouraging this process. From a national debt perspective, this is critical. If the investor base for US treasuries becomes more diverse, more digitally native, and more global, it is easier to roll over existing obligations at reasonable rates. The debt stock can grow in nominal terms, but as long as the cost of servicing it remains manageable and the economy grows, the real weight can be controlled. In other words, a dollar stablecoin held by a young freelancer in Nigeria or a Turkish importer is a tiny piece of the machine that keeps funding the US state. There is also a more experimental frontier where gold and crypto meet, tokenized assets and blockchain-based government bonds. Financial institutions are already piloting systems where traditional securities, stocks, bonds, even real estate shares are represented as tokens on distributed ledgers. The advantages are speed, lower settlement costs, and the ability to program complex features into the assets. For the US, this opens several doors. One is the issuance of treasuries directly on such platforms, allowing global investors to buy and trade US government debt around the clock in a way that is as easy as holding a cryptocurrency. Another is the creation of hybrid products such as a bond that pays interest in dollars, but whose principal is partially indexed to the price of gold or Bitcoin. Investors fearful of inflation might accept a lower current yield in exchange for that built-in hedge. For the government, these structures can draw in new buyers and lengthen the maturity of its debt, smoothing out refinancing needs. Picture a world where a young saver in Brazil, with no access to a US brokerage account, uses a smartphone wallet to buy a tiny slice of a tokenized 30-year treasury that also offers some protection if gold prices spike. Millions of such small positions add up. They turn what was once a narrow market for large institutions into a broad, retail-infused base of demand. Every bond held in such a way is part of the mechanism that allows Washington to keep carrying and slowly diluting its 37 trillion obligations. Now step back and look at the other crucial lever: inflation and growth. Historically, governments with large debts have relied less on explicit repayment than on letting the economy outgrow the burden. If nominal GDP, the size of the economy measured in current dollars, rises faster than the debt, the ratio of debt to GDP can fall even if the absolute debt level continues to climb. Inflation, as long as it is not explosive, helps this process because it increases tax revenues in nominal terms and reduces the real value of fixed-rate debt. This is not an accident. After World War II, many advanced countries used a combination of controlled interest rates, moderate inflation, and capital controls to quietly work down their massive war debts. In the modern US context, something similar can be attempted without formally declaring it. If policy choices encourage a strong nominal growth environment, where inflation runs somewhat higher than the interest rates paid on long-term debt, then every year a slice of the real value of that debt is shaved off. Savers holding long-dated treasuries at low fixed yields effectively pay a stealth tax in the form of lost purchasing power. Their loss is the state's gain. This is what economists call financial repression. It is rarely advertised, but it is powerful. Where cryptocurrency and gold intersect with this story is in how they channel the reactions of those who see it coming. When households and institutions begin to fear inflation or currency debasement, many shift part of their savings into assets they perceive as hedges: real estate, stocks, commodities, gold, Bitcoin. Prices for these hedges rise. For the average worker with a small paycheck and no sophisticated investments, this might feel like a worsening of inequality. Housing becomes less affordable. The rich whose portfolios are filled with assets get richer, and cash savings slowly melt. For the state, however, something interesting happens. If it has its own holdings of gold or digital assets, either directly or via vehicles like sovereign wealth funds or central bank reserves, then the price appreciation of those hedges partially offsets the erosion of its position on the liability side. At the same time, the tax system captures some of the nominal gains in asset prices through capital gains taxes and higher nominal incomes. So while people are trying to protect themselves from inflation, the very act of doing so through asset markets generates tax revenue and, if the state is also an asset holder, boosts its own wealth. Consider a concrete example. A family that kept most of its wealth in cash and low-yielding bonds in the 1970s in the US suffered a large real loss as inflation surged. Another family that held a house, some stocks, and maybe a bit of gold preserved or increased its purchasing power. Now imagine a future decade where inflation is not officially out of control, but periodically runs hotter than expected, while assets like Bitcoin and gold go through cycles of bubbles and corrections. Households who anticipate this might put a small percentage of their savings into a crypto exchange or buy shares in a gold ETF. Their individual defensive moves, scaled up across millions of people, contribute to rising valuations for those hedges. If the US government, directly or via affiliated institutions, has built up positions in these same assets, it benefits from that wave. Meanwhile, the bulk of its debt is still denominated in plain dollars. Over 10 or 20 years, this combination of stealth inflation, asset price growth, and strategic holdings can quietly rewrite the real arithmetic of the 37 trillion figure. There is a human side to this as well. Think of a retiree living on a fixed pension, a middle-aged worker juggling a mortgage and college costs, and a tech-savvy 20-something trading crypto on a phone. They are living under the same national balance sheet, but they experience debt management strategies differently. The retiree might notice that prices at the grocery store creep up faster than the pension check. The worker might see the mortgage interest deduction change, tax brackets move, or house values rise faster than wages. The young trader may see massive upside and downside swings in their portfolio, chasing trends that in aggregate influence liquidity and valuations in asset markets. None of them thinks day-to-day about how the US will reduce its debt, but the sum of their financial behavior is part of the environment in which Washington's strategies play out. If policymakers lean too hard on inflation, the retiree suffers, and political backlash can explode, forcing a reversal. If they are too cautious, allowing interest costs to swallow the budget, the worker sees public services squeezed. If regulation of crypto and digital dollars is too heavy-handed, the young trader's ecosystem shrinks and innovation migrates abroad, possibly weakening the long-term dynamism that the US needs to keep its economy growing faster than its debt. The art is in balancing all of this, using the flexibility of the dollar, the deep well of trust in US institutions, and the optionality provided by gold and crypto to smooth the path. Behind the scenes, technical debates rage over the exact mix. Some experts argue for a more aggressive official embrace of a digital dollar issued directly by the central bank, arguing that it would give policymakers fine-grained control over money and credit, allowing them to direct stimulus or tighten conditions with surgical precision. Others warn that such power comes with enormous surveillance and civil liberty risks, and could provoke political resistance so strong that it undermines confidence in the currency itself. The US has, for now, leaned toward a hybrid approach. Let private actors build much of the digital infrastructure under a broad regulatory umbrella, while the state focuses on guarding the core of the system. Bank reserves, large value settlements, and the legal privilege that makes the dollar the final unit of account. In such a world, big tech firms, fintechs, and even crypto startups effectively become distributors and amplifiers of the dollar, extending its reach into every corner of the planet and into new kinds of applications. Every time a new platform chooses to denominate its in-app token or payment rail in dollars rather than euros or yuan, it marginally strengthens the long-run demand for US assets. Layered onto this is the reality of politics. Reducing a debt load of this size through straightforward measures like cutting spending or raising taxes is deeply unpopular. Efforts to trim entitlement programs such as Social Security or Medicare provoke fierce resistance. Proposals to significantly increase taxes on corporations or high earners ignite lobbying wars and fears of capital flight. In contrast, the indirect methods, allowing a bit more inflation, nudging savers toward riskier assets, gradually extending the life of the debt through longer maturities, and quietly building up strategic reserves, are less visible and therefore more politically tenable. They show up as a background hum rather than a single headline. Many Americans might vaguely sense that things are getting more expensive, or that the economy is weird, but without a clear villain or a single law to blame, their frustration diffuses. Meanwhile, the machinery of debt management keeps rolling. Each auction of new treasuries funded in part by domestic institutions, in part by foreign central banks, in part by stablecoin issuers, pension funds, and ordinary investors. There is no clean point at which one can say, now the debt has been wiped out. Instead, success for the US over the next few decades would look like a set of overlapping trends. The ratio of debt to GDP would slowly stabilize or drift down rather than exploding. The cost of servicing the debt would remain high but not catastrophic relative to tax revenues. The dollar would continue to dominate trade invoicing and global reserves, even as digital alternatives multiply. The gold in US vaults would still be there, perhaps officially revalued, silently bolstering the credibility of the system. Cryptocurrencies would have been tamed, domesticated, and integrated, less a separate rebellion against fiat and more a volatile, innovative frontier sitting atop a dollar foundation. The 37 trillion headline might be replaced by a 45 or 50 trillion number in a decade, but in relation to a larger, wealthier, more digitized American economy, it could feel less like a guillotine and more like a heavy but manageable backpack. In that sense, the phrase quietly wipe out the national debt describes not a secret overnight reset, but a slow transformation of what that debt means. Through careful use of monetary policy, strategic deployment of gold and digital assets, and an active shaping of the future of money itself, the US can attempt to stretch, dilute, and partially offset the burden of its obligations. The story is not about one dramatic gesture, but about a long series of choices made in central bank meetings, congressional hearings, regulatory rulebooks, and even in the code of payment apps. Those choices, though invisible to most people, are how a vast number like 37 trillion is gradually turned from an existential threat into a chronic condition the system can live with, and perhaps over time quietly shrink in real terms, even as the world argues over gold prices, crypto cycles, and the next evolution of the dollar.